34% of Americans have their emergency funds sitting in a bank earning less than 1% interest. Another 11% aren't sure what rate of return they're getting. Welcome, my name's Daniel McCluskey. This past year, I helped 24 clients create a much better alternative for their emergency funds. Let's get into it. What many Americans fail to understand by keeping their money in these sorts of bank is that they are paying for doing this. When you keep $100,000 of your emergency fund in a bank, let's say earning a 1% rate of return, you are getting credited $1,000 a year. You might think that's a good deal because it's a better alternative to keeping it in an account where you're not earning any interest. However, you have to look at how banks are able to credit you this $1,000. The reason banks are able to operate, able to function and stay afloat is because people put their money in banks. They take that money, they go and invest it or put it in other assets. Therefore, they're able to earn a certain rate of return, and then they can credit you the interest. So if they are crediting you 1%, you better believe it's because they're making 5 and 6%, and they are keeping a big chunk of profit off of your money. In fact, we know that when they are taking this money and investing it, it has to be performing at least at 5 and 6%, because there is so many accounts called high yield savings accounts. And it is the same thing as where you're keeping your emergency fund now if you're one of those 45% of Americans. However, it credits you a higher yield, usually right now around 3.8%, but that fluctuates, it rises, it goes down. It is taxable just like the 1%. But if this were the case, if you just moved your money from a low savings account to a high yield, you would be getting another $2,800 a year. Again, that's taxable, but look at it as instead of just gaining $2,800 more a year, right now, by not keeping your money in that account, you are paying $2,800 a year to not do that. Also, all of these banks have $250,000 worth of FDIC insurance, which basically means if this bank goes under, the federal government will make sure that you are paid out your money. You're not going to lose it. If you had more than this $250,000 in those banks and that bank went under, like another 2008 happened, well, you're not guaranteed to get that money back. So especially if you're below this, you don't have to worry about that. So you might as well, if you're going to keep money in a bank, keep it in a high yield savings as opposed to just keeping it in one of those very low 1 to 0% accounts. However, while just simply moving it to a high yield savings would be multiple times better or make a world's difference in the long haul, because not only are you gaining that extra $2,800, this is going to continue to compound each year. If you pan that out over 10, 20 years, it's going to make a massive difference if you even begin to understand compound interest. However, while I do have a high yield savings account for myself for certain money that I need to keep in the bank, I actually take a different approach to this, and that's what I've done with my clients this past year. And that is that, as I mentioned, banks take our money, they invest it, they earn money, and then they can credit us interest. This is how the high yield savings functions. They are taking our money and going and earning rates of return on things that we could go to ourselves. So instead, my idea is to cut out the banks, go look at where they are putting money, put my money there, and earn the full rate of return instead of letting the banks take a 1 to 2% spread and keep it for themselves and their profits. Now, there's a couple places that banks are keeping money. The first and most prominent is loans. These might not be as available to us. Government bonds, bills, notes. They also keep some money in real estate, and they also will keep most of their liquid cash in what is called cash value life insurance. Now, this is actually the alternative that I suggest, that most of my clients do. And what's really important about this is, even if you're going to be someone who's going to come and disagree with me in this strategy, well, look at what the banks themselves are doing. This quite literally is where the banks keep their liquid cash. Banks do have the opportunity to go and keep their liquid cash in other banks if they wanted to, but they don't. And why is that? That's because they understand the safety, the liquidity, and the tax-free nature of cash value life insurance. This functions very simply in what is called bank-owned life insurance, where they are paying premiums, where they want the most possible amount of money defined by the IRS to go towards the cash value portion of the policy and the least amount possible towards the death benefit or the cost of insurance. And because this money that is growing inside of an insurance policy is considered life insurance and not an investment, it is actually growing tax deferred. And if you want to access it just like the banks do, they're accessing it tax free through policy loans. And the concept is the exact same as how the banks credit you money for a high yield savings. Insurance companies take money, they take your premiums, they invest it, they earn a rate of return, and therefore they're able to credit a slightly lower percentage. The difference is, if we look where banks are keeping their liquid cash, it's quite literally in insurance companies. Insurance companies don't need to put their money in other insurance companies because they're simply required by the governments to keep a high percentage of their money. They couldn't be as risky as banks, even if they wanted to, because they're legally not allowed to be. That's why in the Great Depression in 2008, much more banks go under. Only one insurance company had to be bailed out, AIG. Of course, these insurance companies cross-insure, but again, legally they could not be as risky as banks even if they wanted to. And even if you were earning the exact same rate of return, the difference is that this would be happening completely income tax free. Why? Because you're going to access that money through policy loans. And when you pass away, obviously it's a little different in terms of the bank-owned life insurance, but if you, the owner of your policy, pass away, well, what's going to happen? It's going to blossom into the death benefit. Death benefits under Section 101A of the Internal Revenue Code transfer income tax free. So if you're watching this, if you're one of those people that has an emergency fund in a low yielding bank, the very simplest move is just to move it into a high yield savings. I think this is a great solution. However, once that number starts to get a little bit higher, it could be wise to consider using cash value life insurance, continue to get a similar rate of return. However, have that happen completely tax-free in a much safer spot. Hopefully this was helpful. If you'd like to learn about this in much greater detail, subscribe.